decisions made by managers. We're going to look at a special order situation. And there's a couple of things you need to remember whenever you have a special order situation. Number one is that the special order is above and beyond its normal operations, which means the company needs to have idle capacity or excess capacity in order to fulfill or to accept this order. The second thing you need to remember is a special order is a one-shot deal. And because of that, it should not impact your normal operations, your normal sales, your normal customers, because usually a special order gives a special, probably lower price to that particular customer for that particular job because you have this idle capacity and because you've already passed break-even. And because you've passed break-even with your normal operations, some costs, such as fixed costs, are irrelevant to the decision on whether you should accept the special order or not. Because when you look at a special order decision, you look at how much revenue that special order is going to bring in versus what are the costs that you would have to incur, in other words, your variable costs, to accept that order. And most of the time, fixed costs are irrelevant. Why? Because normal operations have already covered them. Let's take a look in our text at SE6. And in SE6, we are a tax preparation company, and we are looking to coming up with a bid price for doing 4 tax returns for special stockholders of a corporation. And it gives me some information. It tells me that for direct materials, it costs on average $1 per page to prepare a tax return. And it also tells me that there are usually 10 pages in an average tax return. So if I was coming up with a bid price for the special order, I would want to say, well, per return, $1 a page, 10 pages, it's going to cost me $10 to prepare a return for the special order. Direct labor, I pay the guys $60 an hour. Well, how long does it take you to prepare a tax return? It takes, according to the problem, 4 hours. So $60 an hour, 4 hours per return. Cost is $240 to prepare this return. That would be part of the bid. Variable overhead is 50 cents per page. Well, we said there's 10 pages in a return, so the variable overhead would be about $5 per page. It also says that we want at least a profit per return of $40. So when I come up with putting that bid together, do you think managers come up with bids all the time? You bet. We're going to include our materials, our labor, our overhead, but not fixed overhead, our desired profit. So our minimum bid per return is $295. But this particular problem said we're not preparing just one return. How many are we preparing? 4. So we need to multiply that by the number of returns, which is 4. So what will I go back to the prospective customer with is a minimum special order bid of $1180 or $1,180. So I'd probably round it up to $1,200, don't you think? And say, well, hey, I could do this job and prepare the returns, but it's going to cost you $1,200 or $1180 at the very minimum. So that's how you approach a special order, only looking at the relevant costs, the costs that change if you accept the special order, to find out what's the minimum price that you're willing to accept.